All right, guys, I'm Mike SAGGESE from New American Funding. I've been in the mortgage business for 17 years, which I know a lot of you in this room have heard this story before, but I got into the mortgage business in spring of 2009, one of the worst times in the industry. The mortgage industry went from, prior to that, anyone being able to get a mortgage, no money down, no credit, no job, no problem, you got a mortgage. Whereas in 2009, after all the housing crisis happened, it became very difficult for the average person to get a mortgage. So that's where I kind of built my business. From that point on, been doing this June will be 17 years doing this. I run a branch of New American Funding. We are a national lender. We're in all 50 states. I focus primarily on New York, New Jersey, and Florida. For those of you that don't know, I moved to the Space Coast. It'll be 2 years this July. I opened an office here in Satellite Beach. I still maintain an office back in Long Island, New York, where I'm from, and I try to go back to New York as little as I have to, especially with how cold it was this past winter. So I specialize in helping people get mortgages. Some people assume it's super easy to get a mortgage. Some people assume they just can't get a mortgage. It's never good to assume. We all know what happens when you assume. So I'm going to go through or basically break things down, sort of what I do, into the simplest three things to kind of understand that banks look at when they try to approve someone for a loan. And those three things are credit, collateral, and capacity, right? You can't just have good credit. A lot of people I hear, hey, I have an 800 credit score, should be no problem. They just assume having the credit score is going to be able to get them the financing they need. Not always the case, because it's not just credit, it's the rest of it too, which is employment, their income, how much down payment do they have, etc. Right? Other people assume, hey, I'm putting 20% down. Doesn't matter that my credit's not good. Doesn't matter that my income's not enough. They just assume because I'm putting a certain amount down that they can get a mortgage. It's not just one of those three things. It's everything. And not only is it important that, I guess from a real estate standpoint, the client's getting educated and knowing what they can get from the bank, but it's even more important to me to make sure they understand what do they want to get from the bank. Some people want to get pre-approved, to buy a house for $500,000. But when they get the monthly payments, they realize they don't want to get pre-approved for a house that's $500,000. At the end of the day, they're getting a loan. They're not paying cash for the house. What's really important is to make sure they're comfortable with the two most important numbers. How much is my monthly payment going to cost me? And it's not just mortgage. It's going to include property taxes, homeowners insurance, and sometimes something called mortgage insurance, depending on the situation, which also affects the monthly payment. The other most important number that they usually have a hard time wrapping their head around is how much money do I need to have? Not just how much am I putting down. It's how much am I putting down? How much are closing costs? A lot of banks don't explain to people what closing costs are, why closing costs are what they are, how we get there, what could change. Because we are giving people an estimate of what closing costs are, but when they get to the table, the final numbers could actually be different, and it can be different in a bad way or a good way, depending on how the lender up front, the person in my position, prepared them initially. And I'll be the first person to raise my hand and tell you, lenders are horrible. Okay, so my business is completely based on referral. I'm out there looking to earn the referral from the real estate agent, the New York real estate attorney, title company, whatever it might be. Don't really do very much advertising at all. Just word of mouth, repeat customers, real estate agents, people who are in a position to refer us buyers, make sure their buyers are taken care of, make sure that if we tell someone they're approved for a loan, they're really approved for a loan. There's not going to be any problems after they've spent months driving these people all over God's country to find a house, to find out they all wasted their time because some internet bank told them they were approved and they really shouldn't have been. They just should have gotten a second opinion from the beginning. Now, New American Funding, we have a wide array of programs and products. Some are very, very normal, commonplace in my industry, like a VA loan, veterans, great program, very important to understand how that works. FHA loans, which is similar to a VA loan, except minimum down payment for a first-time buyer with an FHA loan is a 3.5% down payment. And then you have your traditional conventional loans. Those are the most common loan programs that you'll see out there today. Now, the less common programs, the things that are a little bit more unique and becoming more and more popular as time goes on are things like DSCR loans. I know I've talked about these here before. Non-QM loans, things like profit and loss loans, bank statement programs. we have a lender for Florida that'll basically do a no income check loan. Now, if you're concerned when you hear that, or you decided that sounds a lot like what things, how things were going on back prior to '09 when it was too easy to get a mortgage. The good thing is there are definitely guardrails on these programs where the no ratio program, the no income check programs we offer have a strict down payment requirement, strict credit score requirement. There's guardrails on these programs to prevent a lot of the craziness that happened back with the housing crisis or housing bubble, whatever you want to call it. Okay. The unique thing about a DSCR loan, which is becoming very common in these days, at least in the market we're in, is if you want to buy a property, whether it's a condo, a house, whatever it might be, and you want to rent that property out, whether you want to rent it out to a tenant for a 1-year lease, or you want to put it on Airbnb or VRBO or hire a property manager to rent it out for you and rent it for short term, these programs are great because they don't require all the same documentation that a regular mortgage program would require. We don't need to learn about employment information. We don't need tax returns. We don't need pay stubs. We don't need any income documentation, because the loan on the DSCR loan is based on the actual income that the property will produce, based on speculation of the appraiser, verifying what the market rent is, or based on what the vacancy rate and average daily rate will be when it's rented out as a short-term rental, right? And Nikki knows that changes the type of insurance you have to carry when you're buying property to do that. So in an area like we live in the Space Coast, those loans are very prevalent here, especially in condos, especially in transient vacation-like areas like Cocoa Beach, Indian Harbor Beach. If you're on A1A, there's a lot of that going on. Instead of just kind of lecturing you guys on all these different things we do, I kind of wanted to take questions. Does anyone have any type of question about it? Yeah.
I've had a lot of clients come up to me saying that they don't need to show a profit on their tax return because they're using bank statements to get a mortgage.
That's a good question. So that falls right into the same categories as DSCR loans fall into. So what they're talking about is a bank statement loan program. This is a non-traditional lending program for someone who owns a business, typically, because what the bank will do is they'll analyze 2 years, 1 to 2 years, 2 years is better, but 2 years of their business checking. Okay, and they're going to see money coming in and money going out, and they're going to come up with an income figure we can actually use. So they're using income. It's not as if, hey, income's irrelevant. They're not using the income they report on their taxes. They're going to make more of a common sense decision based on what the business is showing, incoming and outgoing, on their bank statements. Now, those programs are usually, you can do it as a first-time buyer, but understand that all the benefits with down payment assistance that's out there, minimum down payment requirements, that's out the window. Those programs are at least 15 to 20% down minimum and have strict credit score requirements. But for the right person, it solves a problem, because we all know people who own businesses, half of us do in this room. And what do we try to do when we file our taxes? We want to pay as little tax as we have to.
Or never.
So and there's a cost analysis where, hey, I have to either show this much money, pay all this tax to qualify for a regular loan, right? Or I can get this bank statement loan where I can go back to doing my taxes the way I really want to do them. Maybe the rate's a little bit higher, I have to put a little more money down, but I don't have to pay the government all this money. So that's, to answer your question, Lynn, that's what a bank statement loan is. It falls right into the category of what we call non-QM. So it's not a loan that adheres to the government guidelines, which are Fannie Mae, Freddie Mac. So it doesn't fit into those boxes, but it's something that's unique, different for someone in that type of situation.
Sounds riskier, so.
Well, it is, because you're giving someone a loan who doesn't show the income, right? But they are requiring more down. And they are requiring stricter credit score requirements. So they're kind of giving flexibility to the consumer. They're more rigid on the other pieces to try to put a guardrail on it, so that they're not, they're lending to someone with a good track record on credit, and they're lending to someone who has a lot of money down. So God forbid they really can't afford this mortgage, they could sell it. There's equity in the house. The problem that happened, in 08, where these loans were given, they were doing loans like we're talking about, except they didn't require any money down. They didn't care about their credit. So you got somebody who took 100% financing, didn't have any equity in the house, and then the value went down, and then they couldn't afford the payments. So in the program, the way they're doing these programs today, they're requiring more down. They're really looking at credit history to really hedge the risk as far as it turning into a bad loan in the future.
How much higher are the interest rates for those type of loans?
Probably a percentage, but it's not just across the board. It really depends on how good or bad their credit is, how much they're putting down, how much they're not putting down, because minimum is around 15, 20%. If they're putting 30, 40% down, the rate's going to be a lot better than if they're putting 15, 20% down. If their credit score is 800, the rate's going to be a lot better than if their credit score is 680. It really depends.
It makes sense because I've almost always just worked for myself. So like showing that income is like, it's like a huge hurdle. So I'm glad that they're actually using some common sense. Like,
And in a lot of cases, you not only do you have to show your income, you usually have to do it for 2 years.
yeah,
Depending on how long your business, there's a lot of still stipulations to it.
you can't just start a business and be like, look, I'm good to go.
Yeah. Even if you made $1 million in the first month, like it doesn't,
doesn't
they're not going to give you a mortgage so quickly, right?
And I like the first time home buyers too that you talked about before, and I liked also that you guys covered like the down payment or that you hold the mortgage or something. I don't remember the exact details, but when you were talking about that and when you were in the spotlights, I thought that was really cool.
So I think you're talking about the NAF cash program. Is that what you?
Probably, I don't remember.
So we have a really unique program that we do. I always tell realtors or
I know
anybody.
we're going over 10 minutes.
Oh,
so
sorry.
that was one of the things I wanted.
Yeah, so we do all the stuff that everyone else does, but one of the really unique things we do is a program called NAF Cash. So if there's a buyer out there who wants to buy a new home, but they have to sell the house they have now, and they find the new home they love before they found the person who wants to buy the house that they're selling, and the new home is they're losing it because the seller of that house does not want to wait for them to have to sell the current home. We come in and we buy the home for them cash. We let them move into it as tenants, and we rent it back to them while they're taking time to sell their current property. When their current property sells, then we basically deed the new house back to them. So it's not for every situation, but for the right situation, it gets them the house. That's the big thing there. A lot of people, they didn't even list their house yet. They go just kind of window shopping. They go to an open house, and I'm sure
They see something
they see something like, we have to have this house. They're like, will you take our offer? And the seller, we just have to sell ours. And the seller's like, did you list it? But no, they didn't even list it yet. They didn't prepare it. They didn't, declutter it, whatever they need to do, to get the house ready to sell. So now they're in a situation where they found a house they love, they're losing it because they weren't ready. So in that situation, we come in, we purchase under our name with cash, we buy the house for them cash, we hold the house for them, and then we wait for them to sell. Whether it takes them a month, a year, whatever it takes them, we hold it for them while they're attempting to sell their current home.
The only other option in that situation is to do it on contingency, but they're just like not fast enough to do that.
Yeah, so for that situation I'm explaining to you guys, their best case scenario is the seller agrees to their contingency, right? The seller says, hey, sure, we'll take your offer and we'll wait.
If the market's hot, they ain't waiting after that.
They're not. If the house is priced right and there's a lot of activity on the house, they're not going to want to wait. Or maybe the seller just needs out. Maybe they're relocating for work and they can't wait 3-4 months for it to sell. What if the people are selling a condo? In this market, condos take usually twice as long as it takes to sell a house. So it really is depending on the situation.
What if they don't have a separate bank account for that bank statement loan, and they just do everything?
Everything in their personal, probably not going to work.
Gotta have the set.
Gotta have a business account.
Yeah.
All right, thank you so much.
Thank you guys.